And even today, if we look at bottom-up growth rates of some of our digital players like Zomato, Policybazaar, RateGain, TBO Tech, Unicommerce, all these digital players belong to a particular industry. And they are growing leaps and bounds, almost 3 times to 5 times the growth rates of those industries.
Hello and welcome to Gaining Conversations, a podcast about personal finance. I'm your host Ravi Kumar, co-founder of Gaining Ground Investment Services. In Gaining Conversations, I talk to financial experts about personal finance and how they think about investing. If you're interested in meeting your financial life goals and achieving financial freedom, Gaining Conversations is the perfect podcast for you. My guest today is Varun Sharma. Varun has recently joined the investment team at Motilal Oswal as Executive Vice President after spending 10 years with Franklin Templeton. He began his career in 2010 with ICICI Securities as Equity Research Analyst after completing his MBA from IIM Calcutta. The work he did at his previous company was so amazing and fascinating that I thought he would make a great guest. Furthermore, Varun has written a book entitled Valuation Asymmetry, in which he shares insights on how to value the new economy companies, the technology and internet companies. I really enjoyed the book and learned a lot from it. As Charlie Munger used to say, we have 3 buckets of investing. The first bucket is yes, the second bucket is no, and the third one is too tough to understand. Why did the entire internet space fall under the too tough to understand category? With no further ado, let's talk to Varun and understand how he has built the framework to value digital companies. Hi Varun.
Hi Ravi. Thanks for having me here.
Yeah, it's great to have you on Gaining Conversations. Thank you for taking time to talk with me. I would like to begin, Varun, with a quote from your book that really stayed with me. As internet became mainstream, the investment world encountered a new animal for which no cage was ever built. In the past, one would value companies by using one or more established valuation frameworks. But as technology companies started scaling up, investors were faced a mammoth challenge. The question was which cage or framework to capture a particular tech company in. Varun, can you help us understand this?
Sure, Ravi. So see, for several decades, if we go back to even the beginning of the 20th century, we had frameworks that worked beautifully across industries, and as new and new industries started scaling up across the globe, those frameworks worked very well in terms of valuing those companies. Going back to what Benjamin Graham espoused in his own book in terms of establishing intrinsic value based on cash flows and income of companies.
Right.
We also have broader valuation frameworks that talk about assets. And then once you're able to solve for one company or several companies in an industry, you could apply those frameworks very beautifully to any new company that came in those industries. But when technology and internet became mainstream, the biggest challenge that faced investors was that none of those valuation frameworks were applying that easily on those companies, especially because these companies came with a very different, life cycle. They were hyper-growth and they remained hyper-growth for a very long time. The business owners, founders, entrepreneurs did not care about much profit, did not care much about profitability in the short term. So then these companies remained unprofitable for a long time. And they were very, very hungry in terms of, scaling up. So they always had a lot of hunger for growth capital.
Right.
Now, these were not, the characteristics that were demonstrated by actually any other industry in the past. Contrary to this, most of the entrepreneurs in the past were, although they were growth hungry, but they were also quite measured in terms of making sure that they earn profits, that they make cash flows. But this was not something that we were seeing right now. So the challenge was that when one by one, all these investment frameworks were breaking down, the established methods that worked beautifully for a century, we had a big challenge in front of us and we had to solve for that. We had to size up these companies and arrive at their valuations objectively by finding newer frameworks. And I think investment world today is still trying to find reliable frameworks for these companies. And added disadvantage or a difficulty in valuing these companies is that these companies do not belong to the same sector. So you could apply a very, very I would say well-working valuation framework to an industry, But the digital ecosystem, these companies are quite disparate. They belong to various industries. They belong to various sectors. They don't compete head on with each other everywhere. So how do you ensure that if you solve for one or two companies, you will be able to reapply the same valuation method to various other companies? So this was a big challenge, and we solved for that first. And today we feel confident that we have a valuation framework, an econometric model, uh, which solves for several things, not just valuation, but even the fundamental performance of these companies. And that is something which was a big challenge in front of investors, and even it remains today, because if we go through the academic papers on valuations of new age companies today, they have a very standard line in very standard message, which is that the traditional valuation methods don't apply to the new age tech companies. So the challenge is, the challenge still remains. There is no solution even today, and even today, we continue to, when we interact with people, we see that in the absence of a reliable valuation framework, even today, many investors, many analysts, many ecosystem partners try to size up these valuation of these companies with the traditional valuation methods.
So, is there any change after COVID? Do you see these hyper growth companies actually accelerating much faster?
See, absolutely. Any disruption that happens in an economy is actually a digital accelerator. Unfortunately, India should have been, in terms of digital penetration and the size of digital ecosystem, we should have been far bigger today. But India was holding back because of payments issue. We were not able to develop a payment ecosystem, which was very well developed when it comes to some of the developed economies like US, UK, Australia, and even the emerging economies like China. But India was struggling. But what has happened over the last 3-4 years is that with one master stroke, which is UPI, we've been able to solve for the payments issue.
Yeah.
And we have all the other digital pillars already in place. And so India should see the kind of acceleration that US, China, and other economies saw. And COVID was again, one big accelerator when people realized the digital ecosystem is very, very powerful, even at a subscale level in India.
Right. On that context, the digital, ecosystem in India, what are the key pillars, you're looking at?
See, there are 4 key pillars when it comes to digital ecosystem. We need smart devices like a smartphone. We need high-speed mobile internet so that we can interact and we can transact on devices, even on the move. We need a payment ecosystem so that people are comfortable and they find it convenient to transact online. And we need scaled up digital businesses, which is the 4th pillar. So that if someone wants to buy a service or product online, they should be able to find it. While India did exceedingly well on, 2 parameters, which is smartphone penetration, which is 70% plus today, and even high-speed internet penetration, which is 50% plus, which is actually in tandem and in line with the growth that we saw in the US, in UK, in any other economy. But where India lagged behind was actually payments, because of which even digital businesses were not able to scale to an extent to which, US digital businesses have scaled, or even Chinese digital businesses have scaled. But now that we have solved for it, which is an important pillar, which is payments, we are seeing massive acceleration in the entire digital ecosystem that is reflected in the growth rates of digital companies in India.
Interesting. So, you also mentioned in your book that the broad set of technology companies have actually outperformed most of their old economy counterparts, right? So, give us examples. Is that what you're referring to, US and India? What is that you are observing?
See, India, it's already started to happen. But let's take some examples of the US. Amazon and Walmart were in the same broader category, which is retail. And Amazon, in terms of its revenues, has compounded at growth rates way faster, way higher than Walmart. Not just revenues, but even profits. And that is also reflected in stock prices. Similarly, Netflix and Walt Disney were in the same business of entertainment, wherein Netflix has compounded at a rate way faster than Walt Disney. We can find one-on-one equivalent in the US and even in Chinese ecosystem, in UK, all other countries, wherein a technology player came into an industry where there was a large industry player, but traditional business, non-digital business, and the technology and digital player actually disrupted that space and became even bigger than the non-digital business in that space. Look at Apple, for instance. It came up with digital phones, smartphones, but Nokia lost out. Look at, for instance, the comparison between Meta and News Corp. So the entire media space is owned by Meta in the US. Look at Tesla, what it did with, to the automobile industry. And even today, if we look at, bottom-up growth rates of some of our digital players like Zomato, Policybazaar, RateGain, TBOTech, Unicommerce, all these digital players belong to a particular industry. And they are growing leaps and bounds, almost 3 times to 5 times the growth rates of those industries.
Yeah, that's really fascinating to know that. So, on average, Indians, how much do they spend time on, the digital?
So it is very interesting that Indians are if we have 24 hours in a day, we X out 10 hours for our sleep and personal and family time. So at max, we have 14 hours of productive waking time in a day.
True.
And an average Indian is spending close to 7 hours online. Now, there's a big convergence gap that we as users and consumers are spending 50% of our productive waking time on devices, yet on an average, we are spending only 5% of our wallets online.
Okay.
And this gap has converged very well in US and China, where similar numbers are there that an average American or average Chinese person is spending 50% of their waking time on devices, digitally connected, and they are spending 30% of their wallets online. India has lagged any other country, any other developed economy also in the world, simply because we had this payment
system, correct.
And now we are at 5%. Now that we have solved for everything, we should feel very, very encouraged and excited that we are also going from 5% to 30% in a short span of time.
So you mentioned in your note that the digital GDP growth is going to accelerate. Any numbers on that? What is that you're looking at?
So currently, the way we find some of the reports on digital GDP is that if India's digital GDP is close to 8%, and it is slated to go to 20% over the next 6 years, which means that if the Indian GDP is going to compound 1.7 times over the next 6 years, the digital GDP is going to compound at 4 times. To put it in CAGR terms, what we would expect over the next 10 years is that if Indian nominal GDP grows at 9 to 10%, the digital ecosystem will grow at 25 to 30% CAGR as an ecosystem.
So my next question is, you're coming with a new fund, at Motilal. Tell us, more about this fund. What is that the fund is looking at?
So I'm going to be running a pure true to label digital strategy. Very, very excited about the growth rates of these companies and the long-term potential in terms of scale up. I want to bring to your attention the fact that the digital companies in the US, when they have scaled up over the last 10, 15 years, they have become phenomenally large in size. Just imagine the market capitalization of some of the largest digital companies and look at the market capitalizations of those companies in other sectors. For instance, the largest bank or the largest retailer or the largest FMCG player, and compare that with trillions of dollars of market caps that some of the largest US companies have. And this has all happened. So like Benjamin Graham used to say, markets are a weighing machine in the long term, voting machine in the short term. If they are a weighing machine in the long term, stock prices should reflect the business growth that is happening over a period of time. So what we believe is that if the ecosystem continues to grow at that 25 to 30% CAGR, the portfolio and the stock returns should also follow the same business compounding that should happen. Now, on top of it, if we get valuation improvement also, we'll be more than happy. But as investors and analysts, our first job, and first confidence should always be on business growth. And we are seeing business compounding at this rate. This is the strategy that we will, follow in this digital fund. We do not intend to be an IT services fund. We may take some exposures tactically in IT services, but that industry is low growth industry now. It's scaled up very well, very respectable size when it comes to the global industry. Indian IT industry has become big, but the challenge is of long-term growth. But when it comes to digital is where IT services was 25 years back. Very low penetration, slated to grow very high. And we believe that, the next few decades belong to these digital companies, and we will construct a fund purely digital.
So you think the current valuations of digital companies are still, not catching up to the, compounding of their business?
Absolutely. See, if we aggregate all of the entire digital ecosystem, over the last 5 years, the digital companies have scaled up 5 times. So from a revenue base of 100, they've gone up to 500. but an average digital stock has scaled up only 2.5 times, which means that these stocks are not even currently taking the full impact of the business growth that has happened in case of digital companies. From there, from that standpoint, we actually feel that it's a great opportunity to invest right now, because at some point of time, the markets will take into cognizance the business growth that is happening. The second aspect is of valuations. Now, 3 years back, there was a lot of, I would say, skepticism, and there was a lot of doubt in the minds of Indian investors and analysts whether these companies, which when they were getting listed, whether they will ever turn profitable, whether they will even survive. But I think we don't have those doubts today. When the businesses have scaled up 5 times, when the businesses have demonstrated that they can turn break even, they can also make profits if they don't grow so high, but they choose to grow. It's a conscious choice to grow at a very high rate. That means valuation should rather be favorable today versus 3 years back. So when we combine both these aspects, that we are yet to see the impact of full business or compounding in these stocks, and on top of it, we should expect better valuations. We see it's a phenomenal opportunity in terms of these stocks being massively undervalued.
And the other question is, this digital space, the companies getting listed, do you see this in, the universe increasing?
Absolutely. We are seeing every year anywhere between 3 to 5 companies, new 3 to 5 companies in the digital space coming up for listing.
Across sectors.
Across sectors. And this space is growing phenomenally. And so many companies have scaled up and yet not gotten listed. You're from Bangalore, you know that there are so many companies in Bangalore itself which have very decent scale and must come up for listing. And I think one of these is coming up for listing very soon. I think this ecosystem itself can accelerate the overall universe that we can invest into.
And it is just not restricted to consumption or anything. It can be, or is the fund more skewed towards consumer technology?
No, not at all. There are different types of technology. There is B2C, there is B2B, there is B2B2C. Let me take a few examples. Right. See, we might say Zomato is B2C, but Policybazaar is B2B2C, right? They are selling insurance companies' products and selling to the customers. RateGain is a purely B2B company. eMudra is largely B2B. If you look at IndiaMart, it is B2B. Just Dial is largely B2B. InfoEdge, most of the business is B2B. So, contrary to the perception that these are B2C companies, there are many companies which are B2B and B2B2C also. So it spans across all, I would say, the spectrum of business models that can be established in an economy.
Okay, great. So I want to ask you one question. Since you've run this strategy earlier and it is performed very well in the last 2 years, and then what do you know about the world of investing today that you wish you knew back in early 2010 when you just started? Has anything changed significantly, or you felt that this framework, if you had used 10 years back or 15 years back?
See, I think clearly the most important thing is that when we invest, when we're investors, and even when we are analyzing an industry or a set of companies, we should always keep in mind the long-term opportunity. See, the long-term wealth, the generational wealth, and even wealth for, persons, organizations, whenever they make investments, when the long-term compounding happens is when the real, compounding benefit comes into the picture.
True.
Now, as investors and analysts, we should always focus on that piece rather than being tactical about opportunities. Yes, some people try to play tactically as well. But the real benefit of compounding only happens when you've identified spaces and industries that can grow over the long term. I wish I had developed this valuation model 10 years back. But even if I had, had I developed it 10 years back also, we did not have too many companies to invest in the digital space. The digital space in India has only developed 3 to 4 years back. And I was lucky enough to have put in the effort and have studied the industry for a long time to be able to develop, these equations, these valuation models, regression models, that at the right time I was able to capitalize on that. As I told you, I wish I had known. I could have developed it in the past. But a lot of these things also come with experience. after you've also made mistakes, after you've also had good runs, and possibly this is the right time for it to happen. That's the only thing. I think there's nothing else I could have done, 10 years back to capitalize on this opportunity, but it happened at the right time.
Yeah, I am with you on that. So, is there any other fund which is closer to this kind of framework in India?
See, in bits and pieces, some funds have exposure to digital. The challenge, however, is to have a fund and also have a portfolio manager's track record to be able to deliver on this, because this is not an easy space also. That is where we see, that kind of gap, that lacuna, that we don't have that. But I'm quite positive that, we might see some more funds in future, which will be tapping this opportunity as well. But again, the challenge is on valuations, that unless somebody is very, very convinced about their own valuation framework of these companies, we don't want to make mistakes. Right? This is a winner-take-all market. So it's going to be an acute monopoly eventually of these businesses in their respective verticals, right? So that is something that needs very careful attention, and that needs meticulous approach towards investing in this space. So I would be positive that yes, this space is something that will get a lot more investor attention and interest. But as a portfolio manager, one has to be very, very methodical about investing in this space.
Okay. So finally, Varun, a question I like to ask all the interesting people I chat with. Can you recommend one book that you think everyone must read, apart from, Valuation Asymmetry, of course?
See, I will give you a little bit of context here, and I will not tell you just one book. I will tell you two books, which
Great.
I think are very useful.
Yeah.
See, when we are talking about digital, we are talking about a space which is very different. It does not align itself with the traditional frameworks, which means that one needs to have the capability to be able to evaluate multiple different scenarios in future and appropriately value the stocks. From that perspective, I believe that Nicholas Nassim Taleb has done a fantastic job with his book called Anti-Fragile. That is an approach to value scenarios, value situations, and look at companies how they will what they will do over the long term. The second book that I want to highlight is Fortune's Formula. See, both Anti-Fragile and Fortune's Formula are books which are very, very unconventional. And they would make an investor and analyst think very differently. Imagine what can happen in future. And will provide such unique perspectives about investing, which will be extremely useful. Both these books have been extremely useful for me to be able to develop a thought process of valuing these companies. And I think not just, and I will make an interesting statement here, that we have to take now these valuation approaches and these valuation perspectives and apply these approaches to traditional businesses as well. Because some of the traditional businesses may also start to become non-linear, to become more bold, to become more aggressive. And these two books have been amazing in terms of providing very, very differentiated perspectives on how to actually evaluate future scenarios.
That's a great recommendation, Anti-Fragile and Fortune Formula, right? So I will add it to my reading list. Varun, once again, I thank you for sharing your thoughts with us. They were extremely insightful. And thank you for being so generous with your time today. And we wish you good luck on your new fund. And well, folks, I hope you enjoyed this episode of Gaining Conversations with Varun Sharma. I know I did. We'll be back with the next installment of Gaining Conversations soon. Happy investing. Thank you.
Thank you, Ravi.